Hi everyone, welcome back. In this session, we are actually going to continue our discussion on AS 13 and we are actually going to see the accounting for investments. If we have actually gone and acquired an investment in debenture or an investment in equity share, how do we actually account for those investment in debentures and equity shares is what we are actually going to see now. Now let's start with initial recognition. What do we mean by initial recognition? Initial recognition refers to the accounting when I'm purchasing the security. What is the accounting that I'm going to do in my books of accounts? When I'm initially going to record it in my books of accounts at the time of purchase, what are the journal entries that I would actually post? Now, on initial recognition or on purchase of some security, let's say purchase of a debt instrument or a debenture, I am going to recognize the investment in my books. So I will debit investments. All right. I am purchasing an asset and therefore I will debit investments and I will credit bank account. I'm going to credit bank account because there's going to be a cash outflow. All right. So just like how when you buy a fixed asset, you debit a fixed asset. Over here also, we are buying an investment. You've purchased an investment or a debenture, and therefore you're going to debit that investment in debentures and you're going to credit the bank. Now the amount is going to be the cost of the investment. All right, the value that we are going to debit is going to be the cost. Therefore comes our next discussion of what do we mean by cost? What is supposed to be included in cost? Now cost is nothing but the consideration that I'm giving. What the consideration that I'm giving is what we are going to refer to as cost. Now, this consideration will also include brokerage cost and any other acquisition cost. If let us say I've had to pay some fees or stamp duty or some taxes at the time of purchase, that will also be included in my cost. All right. So let us say if I've purchased an equity share for 1,000 rupees, I paid brokerage at say 20 rupees. I paid say stamp duty of 15 rupees. I purchased the share for 1,000, brokerage 20, stamp duty 15. The amount of at which I will be recognizing this investment will be 1,000 plus 20 plus 15, which is equal to 1,035. All right, I will be recognizing it at the consideration given. The total consideration given or the cash outflow that has happened to me is actually 1,000, which is the security price, plus 20, which is the brokerage, plus 15, which is actually stamp duty that I've paid. So the total value of investment will be 1,035. So I debit investments by 1,035. I credit bank because there's a cash outflow of 1,035. So I will debit obviously the debit and credit are equal and opposite. Now, just as a point to remember, if they're mentioning brokerage as percentage, all right, let us say if brokerage is being mentioned as 2%, as 3%, 1%, all right, brokerage, that percentage is supposed to be applied to the transaction cost, all right. The brokerage is not supposed to be applied to the nominal value or the face value. Earlier, for interest, I had mentioned that interest is supposed to be applied on the face value or the nominal value. Whereas over here, brokerage is supposed to be applied on the transaction cost. What is the amount that I've paid for the share? All right. So let us say if the nominal value of the share is 1,000, I have paid, say, let's say 10,000. Brokerage will be calculated on 10,000, whereas dividend will be calculated on 1,000 only. All right. I'm just repeating myself. Let us say the face value is 1,000. I paid 10,000 rupees as the cost. If I'm calculating brokerage will have to be calculated on the 10,000, which is the transaction price that I paid, whereas the dividend will be calculated on the face value, which is 1,000 rupees. All right. So this is where if the question is giving you brokerage in percentage term, I'm just clarifying that brokerage is supposed to be applied on the transaction cost and not on the face value. All right. Now, consideration can be either in the form of cash, predominantly it is going to be in the form of cash, or it can also be in the form of, let us say I have purchased investment in Reliance shares by giving my own shares. All right. I have issued my own shares and I've acquired Reliance shares. All right. I hope the transaction is clear. I have acquired Government of India debentures. You had Government of India debentures with you. Government of India bonds with you. You have given me the Government of India bonds. I've purchased GOI bonds from you. I am giving you my own shares. Instead of paying you in cash, I'm giving you my own shares. All right. That is also actually, that can also be a way of acquisition. Alternatively, let us say I have purchased Government of India bonds from you, or I've purchased Reliance shares from you. I have given you my iPhone 14, all right? I have given you my iPhone 14 instead of giving you cash. This is also possible. Predominantly, it will happen in the form of cash, but there can be cases where I am actually not giving out cash, but I'm actually giving out either my own securities or I'm giving out any other asset that I'm holding. I can issue my own securities or any other asset that I'm holding. I am having a land on my name. I'm giving you that land and I'm taking Government of India bonds from you. I'm giving you that land and taking Reliance shares from you. This is also obviously possible, right? Now the question is, if I'm giving out, let's say, if I'm issuing my own securities, or if I'm giving you the land over to you, at what value are we going to recognize investment? At what value will we recognize investment is the question. Now, like I mentioned, cost is actually nothing but consideration that we are actually giving. All right, cost is over here is nothing but the consideration that we are actually giving. 1 second. Right. Cost is referred to as the consideration that we are giving, right? In case where I'm issuing my own shares, if I'm issuing my own shares or my own debentures, then the consideration that I'm giving is actually the fair value of my own shares or securities. All right. I'm using the word fair value for the first time. For now, for the sake of understanding, think fair value to be the same as market value. All right. So think fair value to be the same as market value. When I'm giving you my own shares or my own entities debt instruments, then the investment that I'm purchasing, the Reliance shares that I'm purchasing will be recognized at the fair value of my securities that I'm issuing. It will be recognized at the market value of my entity's securities. It will be recognized at the market value of my own entity's securities. All right. So if the consideration is in cash, there is absolutely no problem. Whatever is the cash outflow, I will recognize that as the cost of investment. But if the consideration is not in the form of cash, but if the consideration is in the form of my own, my own entity's equity shares or my own entity's debentures, then I will find out the fair value of my own equity or debt instruments. I will find out the fair value of my own equity or debt instruments, and I will say that the investment in Reliance which I'm purchasing is equal to the fair value of the securities that I am issuing. I'm going to presume that the investment that I have acquired is equal to the consideration that I've given, which is the fair value or the market value of my equity shares or the debt instruments that I have issued of my own entity. Now, I also spoke of a third case where I am actually giving you my iPhone 14. I am giving you my piece of a land, and I am purchasing investment in Reliance. All right, I am purchasing Reliance shares by issuing iPhone 14 or a land. In that case, also, if you logically think of it, consideration given is nothing but iPhone 14. All right, let's put land aside. Let's talk about iPhone 14. I have purchased 1,000 shares of Reliance by giving you an iPhone 14. What is the consideration given? Consideration given by me to you is iPhone 14. All right. So I will actually have to recognize the investment in Reliance at the fair value of iPhone 14. All right. I have to recognize the investment in Reliance at the fair value of iPhone 14 that I'm giving you. Let us say the fair value of iPhone 14 is 1,14,000 rupees. All right. iPhone 14, 1,14,000. All right. So ideally, logically speaking, I should be recognizing investment in Reliance at 1,14,000 rupees. Now, there is a slight problem over here because things like iPhone 14 are not actively traded on an exchange, all right? Where it came to my own entity's equity shares or my own entity's debt securities, you are possibly able to find out the market value because maybe it is actually trading on an exchange and you're able to see the market value. Whereas in case of an iPhone 14, let us say this is not a brand new iPhone 14, it is a little used iPhone 14. All right, obviously the fair value is not very easily determinable. The market price is not very easily determinable because this is a second-hand phone. A brand new iPhone 14, I know the cost, but how do I know? How do I determine the fair value or the market value of an iPhone 14, which say I've already used for 3-4 months? It's obviously a little difficult, right? So therefore, what the accounting standard 13 has done is, if I am actually giving away any asset, if I'm acquiring investment in Reliance by exchanging it with another asset, then it is actually giving me a choice. take the fair value of the asset given up. What is the fair value of iPhone 14 that you have given up? Take the fair value of that, compare it with the fair value of the securities that you have acquired. You have acquired fair value of Reliance. I mean, you have acquired Reliance in equity shares. Find out the fair value of the Reliance equity shares. Look at whichever is more clearly evident. All right. For example, in my illustration, investment in Reliance has got a clear price on an exchange, whereas this iPhone 14 is more an approximation that I have done for the purpose of just giving information, right? So over here, more clearly evident is the Reliance share price. More clearly evident is the Reliance share price, and therefore I will recognize the investment in Reliance at the fair value of Reliance itself, which means I am actually going to see what is the market price of Reliance on the date of purchase. I will multiply that with 1,000 shares and I will recognize the investment at 1,000 multiplied by the market price. I'm repeating myself. I am going to say, I am going to see the fair value of the asset given up, which is the fair value of the iPhone 14 that I've given up. I will compare it with the fair value of the securities issued. I'm not doing whichever is lower, whichever is higher. I am going to see which is more clearly evident, all right? Whose fair value is more clearly evident. Fair value and market value, think of it now as synonymous. There is a difference, obviously, which I will come to in some time. See whichever is more clearly evident, recognize your investment at that particular fair value of whichever is more evident. All right. In my example, the fair value of Reliance would be more clearly evident. Therefore, recognize the investment in Reliance at its own fair value rather than recognizing it at the fair value of the asset given up. All right. I will take an illustration to explain this a little more in detail. Now let's take this example where I've actually gone and purchased 1,000 shares of ICICI Bank whose market price on the date of purchase, the market value or the market price of the ICICI Bank on the date of purchase is 700 rupees. So I've purchased 1,000 shares at 700 rupees, which means the fair value of the securities that I've purchased, the fair value of ICICI Bank shares that I've purchased is 7 lakh rupees. It's 7 lakh rupees, 1,000 multiplied by 700 each. Now I am going to give an example of non-cash consideration. All right. Let us say in case one, I have issued my own entity's equity shares. I've issued my own equity shares. I have issued 800 equity shares and the market price of my equity share is, let us say, 850. Quantity 800, market price of my own equity shares is 850. All right. So I've purchased 1,000 shares. I've purchased 1,000 shares from you. Instead of paying cash to you, I am giving you my own shares. I'm giving you 800 shares whose each price is actually 850. Now, in this case, the investment in ICICI Bank, the shares of ICICI Bank will be recorded at the market value or the fair value of my own equity shares that I have issued. The investment in ICICI will be initially recognized at the fair value of my own equity shares that I have issued, which is 800 multiplied by 850, which is 6,80,000. All right. I am going to recognize the investment in ICICI Bank, the investment in equity shares of ICICI Bank. I will be recognizing it at 6,80,000 rupees on day one. All right. Although the fair value of ICICI Bank was actually 7 lakh rupees, the fair value of the shares that I actually purchased was 7 lakh. I will still recognize it at 6,80,000, which is the fair value of the consideration that I've given. It is the fair value of the equity shares that I've issued. Now let us say in case 2, I have purchased 1,000 shares of ICICI Bank by giving a land which is worth 7,60,000. I'm giving you a land that I own and the value of that land is 7,60,000, and I've mentioned that the fair value of land is more clearly evident. All right. What do I mean by that? Which means I am going to compare fair value of ICICI Bank, which is 7 lakh rupees, the fair value of land, which is 7,60,000. Which of the two is more clearly determinable? Which of the two is more clearly evident? I am going to take that, which in this case is fair value of the land being more clearly evident. I will recognize the investment in ICICI Bank at 7,60,000 rupees. Although I am actually receiving shares of ICICI worth only 7 lakh, but because the fair value of the land, fair value of the consideration that I'm giving you, which is the fair value of land, is more clearly evident, I will recognize the investment in ICICI Bank at 7,60,000 rupees. Next, moving on to case 3. Let us say I have purchased equity shares of ICICI Bank from you. I am buying it by exchanging a car worth 7,30,000 with you. I am owning a car whose worth is 7,30,000. I'm giving you my car and you are giving me 1,000 shares of ICICI Bank. In this case, I'm mentioning that the fair value of ICICI Bank is more clearly evident, which means what would I have done? I would have compared fair value of ICICI Bank, which is 700 rupees or 7 lakh rupees for all the 1,000 shares, compare it with 7,30,000, not whichever is higher or whichever is lower, which of it is more clearly determinable, which of it is more clearly evident. Is the fair value of ICICI more evident, or is the fair value of the car more evident? In this case, I'm saying that the fair value of ICICI Bank is more clearly evident, and therefore I will recognize the investment in ICICI or at 7 lakh rupees itself. I will be recognizing it at the fair value of ICICI Bank only, which is worth 7 lakh rupees. Obviously, whether investment in ICICI or whether the fair value of ICICI or fair value of car, which is more evident, is a call that management is going to take. All right, they are going to look at the facts and circumstances, and they will actually take the final call of which of it is more clearly evident. All right, so that is how we are actually going to recognize. In first case, we will recognize the investment in ICICI Bank at 6,80,000. In the second case, we will recognize it at 7,60,000, which is the fair value of the land that I'm giving. In the third case, I will be recognizing it not at 7,30,000, but I will be recognizing it at 7 lakh rupees, which is the fair value of the ICICI Bank shares itself that I've actually purchased. All right. So quickly summarizing, if the consideration is in the form of cash, the question is clear. Whatever is the cash outflow, including the brokerage cost, including any stamp duty and fees, you capitalize it. You include it in the value of investment. When I utter the word capitalize, what I'm meaning is you actually show it on the balance sheet in the investment value itself, and you do not take it to P&L account. All right. If you are actually if you're actually acquiring an investment by issuing your own entities equity shares or debentures, you will recognize it at the fair value of the shares that you're issuing, fair value of the shares or debentures that you are issuing. If you're acquiring it by exchange of by giving any other asset, you will see whichever is more clearly evident, and the investment in ICICI Bank or the investment in Reliance shares or the investment in Government of India bond will be recognized at fair value of the asset given up or fair value of the securities acquired, whichever is more clearly evident. All right, that is with regard to initial recognition, which means when you purchase an asset, when you purchase an investment for the first time, this is how you will actually recognize. The journal entry was simple: investment debit to bank. The question is, at what value are you going to recognize investment? All right, if it is for cash, obviously it's nothing but the cash outflow, and we have seen how we are going to recognize if you're issuing your own equity shares or if you're giving any asset that you own and you're acquiring investment in debentures. All right. Now moving on to subsequent recognition. What do we mean by subsequent recognition? Recognition after the date of purchase. What is the accounting that we are going to do after the date of purchase? That is what we refer to as subsequent recognition. Now, when we purchase, say, a debenture, we are going to receive interest or we are going to receive dividend in case of a share. All right. So we are going to pass a journal entry, bank account debit to interest income or to dividend income. All right. I will receive a cash. Therefore, I debit bank account and I'm going to credit income. All right. Because it's obviously an income for me. I credit interest income or dividend income, which will eventually be shown in your P&L account. All right. These will be shown in the P&L account. If, let us say, I've not received the interest yet and I'm accruing it, then I create an asset. All right. If I've not received, but if I'm accruing interest, then I create an asset called accrued interest. All right. I'm creating an asset in the form of interest receivable. I have interest which is receivable from the company, and I'm actually going to show it as an asset on the balance sheet in the form of accrued interest, and the corresponding credit will still be interest income. So if I've received it, it will be bank account debit to interest income. If I've not received it, if I'm only accruing it, then it will be accrued interest asset debit to interest income. Accrued interest is an asset which is reflecting interest receivable, and I will be showing it on the balance sheet on the asset side. There is a concept called as pre-acquisition dividend, which we will refer to later point when we are discussing the equity section. All right, I'm not getting into it right now, but I'm just giving you a passerby reference that there is going to be a concept of pre-acquisition dividend that we will talk of, which has a little unique treatment and is going to be a deviation from what I just spoke. All right, it's going to be a slight deviation from what I actually just spoke. That is the first part of subsequent recognition, which is recognizing interest income or dividend income. Now, as part of subsequent recognition as well, when I purchase an asset, let's say on the 1st April 2023, I am actually going to pass the journal entry that we first saw. Then let us say on 31st of March 2024, I will be receiving interest. All right. I have purchased it in April 23. I'm receiving interest in March 2024. On March 2024 as well, I'm going to prepare a balance sheet for myself. I'm going to prepare a balance sheet where this investment will continue to be shown in the on the balance sheet on the asset side. All right, I've not disposed of the investment. I'm continuing to hold the investment in my balance sheet, and I will be showing it on the asset side. Now the question is, at what value are we going to show it in the balance sheet? Now, for this purpose, we actually have the split between current and long-term investment. If it is a current investment, AS 13 requires us to show it at cost or fair value, whichever is lower. All right. On the balance sheet date, in case of a current investment, if this investment is a current investment, you are supposed to show it at cost or fair value, whichever is lower. All right. You're supposed to take it at whichever is lower. Just like how under AS2, you are taking cost or NRV, whichever is lower for inventories. Over here, for current investments, you're taking cost or fair value, whichever is lower. Again, fair value, think of it as market value for a moment. So it's cost or market value, whichever is lower. In case of a long-term investments, you will typically show it at cost only. All right. Long-term investment, you do not, your long-term investment meaning you are intending it to hold it for more than 12 months. So what the accounting standard 13 is trying to do is it's trying to say that you're not bothered really about the fair value fluctuation. Fair value can keep going up and down slightly. You're not really bothered about momentary fluctuations in fair value. We are more having a long-term objective, and therefore you continue to show it at cost only. All right. You don't have to do cost or fair value, whichever is lower. Continue to show it at cost. But if there is any diminution in the value of investment, if there is any decline in the value of investment, all right, the word is diminution, any decline in the value of investment, which is permanent in nature, all right, any decline in the value of investment, which is permanent in nature, which means that decline is possibly not going to get reversed. It is not a momentary fluctuation like we were speaking of, but it is a permanent decline in the value of investment. That if there is any significant diminution, then in such a case, you are going to actually recognize an impairment or a provision for diminution, and you will be showing in the balance sheet not at cost, but you will be showing it at cost less any provision for diminution. All right, you will be showing it at cost less any provision for diminution. I'm repeating myself, for long-term investments, the AS 13 is trying to say that you're not really bothered about short-term fluctuations. So do not look at the market value. Do not look at the market value. But if there is any decline in the value of investments, which is permanent in nature, the words actually used are not permanent in nature, any decline which is other than temporary in nature, I am just trying to say that it is permanent, but the words actually used are any fall in value, any decline in value, which is other than temporary in nature, then in such a case, in such a case, it is called as diminution in the value of investment, and you will actually create a provision for impairment or a provision for diminution in the value of investment. And in your balance sheet, you will show it at cost minus provision for diminution. Just like how debtors, you show gross amount minus provision for bad and doubtful debts. Over here also for long-term investments, you're going to show cost less provision for diminution in the value of investment, and then you will show a net amount. All right. So that is a balance sheet date measurement. Current investments, you're going to measure it at cost or fair value, whichever is lower. Long-term investments, you're not going to be bothered about fair value. You will see if there is any impairment or any other than temporary decline in the value of investment. In such a case, you will then call it as a diminution, and you will recognize a provision for diminution, and you will be showing it at gross amount minus provision for diminution is equal to net amount. So the net amount will be shown on the balance sheet. Now, just like it's exactly the same as debtors. Debtors, you have a gross amount minus provision for bad and doubtful debts is equal to the net carrying amount, right? Exactly the same way, you have cost minus any provision for diminution, which is equal to the net amount that at which we are going to show in the balance sheet. Just like how provision for bad and doubtful debts was an expense in the P&L. To create a provision for bad and doubtful debts, you used to do P&L expense debit and then credit that provision for bad and doubtful debts reserve, right? The provision for bad and doubtful debts account. Over here also, you're going to debit your P&L, you're going to show an expense in the P&L, and credit is going to be given to the provision for diminution. All right, this provision for diminution is going to actually have a credit balance. But are you going to show that credit balance on the liability side? The answer is no. Just like how provision for bad and doubtful debts, although it had a credit balance, you were showing it as a reduction from the asset. You were showing it as a reduction from the asset. Same way, provision for diminution also is not going to be shown on the liability side. It's going to be shown as a reduction from the value of the asset. Remember this as a golden rule. Any contra asset, all right, if you're creating a provision for any asset, that will never be shown as a liability. It is always going to be shown as a reduction from the asset. Debtors minus provision for bad and doubtful debts. Inventory minus provision for obsolete inventory. Cost of investment minus provision for diminution. It's always going to be shown as a reduction from the asset, and it's never going to be shown on the liability side, although it has a credit balance. All right, so on the balance sheet, you're going to show show the long-term investments usually at cost. However, if there is any other than temporary decline in the value of investment, then you will actually create a provision for diminution, and you will be showing it at cost less provision for diminution or cost less provision for impairment. Impairment and diminution are interchangeable words. And like I mentioned, that diminution or that provision that you're creating will be a charge to the P&L account. It will be an expense in the P&L account. All right. Similarly, over here also on the left side for current investments, when you're doing cost or fair value, whichever is lower, any change, any gain or loss that you will have will be shown in the P&L account. Now the question will be over here, you might think that we can never have a gain. We're always going to have a loss only, right? But that's not true. You may actually have a gain, which I will come through in examples. All right. So summarizing, balance sheet date measurement, the bifurcation that we made between current and long term comes of use over here. All right. Earlier, I spoke of the classification between current and long term, but I really did not tell you the use of it. Why did we classify it? Because of the balance sheet date measurement difference. In case of a current investment, I'm actually bothered about short-term fluctuations because my intent is to sell it in the near future. So I am bothered about the short-term market fluctuations, and I will be recognizing it at cost or market value, whichever is lower. Although I'm uttering the word market value, the AS13 is calling it as fair value, and it is actually fair value. I will come to the fair value definition in the next session, but it's going to be at cost or fair value, whichever is lower. For example, in the previous example that I took, the fair value of ICICI, the fair value of ICICI Bank initially on the date of purchase was say 700. That is my cost, all right? Because say, it was a cash transaction. I paid 700 to purchase that ICICI Bank equity share. Say by the time I reached the balance sheet date, fair value of ICICI Bank say was 720. Okay, I purchased it at cash using cash for 700. On the balance sheet date, it is 720. 700 or 720, whichever is lower. 700 is lower. All right. So I do not have to pass any journal because I have recorded it in my books at 700 already. When I actually paid cash, I recorded it in my books at 700. Now the fair value is 720. I do not have to make any adjustment. All right. It is already coming in my books at 700 only. Therefore, no adjustment required. But if the fair value, the market value of ICICI Bank is, say, let us say, is 670. 700, I purchased it in cash. 670, it is it is the market value on the balance sheet date. Then I have to recognize a loss of 30 rupees. So I purchased something for 700. I am actually holding the value of that asset on the balance sheet date is 670. I will be recognizing a loss in the books of accounts. I will be recognizing loss in my accounts, and the entry for that is going to be loss account debit, loss on fair valuation account debit to investment account. All right. If there is any loss that I'm incurring, I will be recognizing that loss in my P&L account. Once I recognize that loss, the entry will be loss debit 30 rupees to investment 30. So originally I had an investment at 700. I'm reducing the value of investment by 30 rupees. So 700 minus 30, the investment will now appear in my books at 670. The investment is now appearing in my books at 670, which is the fair value. So I've applied the principle of cost or fair value, whichever is lower. The cost was 700, fair value was 670. Therefore, I've brought down the value of investment in my books from 700 to 670 by recognizing a loss of 30 rupees. This is an unrealized loss. All right. I'm calling it as an unrealized loss because I have not sold the investment. Once I sell it, it is going to be called as realized. Since I've not yet sold it, it's going to be called as unrealized. Now, in case of any diminution, if I want to recognize any diminution, the entry is broadly the same. Let us say I've purchased ICICI Bank shares, 700 rupees. I believe that there is now a permanent decline in the value of investment. Let us say ICICI Bank share has crashed down to 300. From 700, it has come down to 300. And this decline is not a temporary one, but it is a permanent one. It is other than temporary in nature. Abroad, it is called as OTTI. All right. In India, we do not refer to it as OTTI. OTTI stands for other than temporary impairment. All right. Other than temporary impairment. In India, we do not refer to it as OTTI. We call it as any other than temporary decline in the value of investment. So let us say that fall from 700 to 300 is other than temporary in nature. All right. So I now need to show my investment at, let's say, 300 rupees. Now what I will do is the entry in essence is going to be the same, but I am actually going to create provision for diminution. I'm not going to touch the investment account. I am going to credit provision for diminution. I will create an expense of 400 rupees called diminution expense, and I'm going to create a corresponding provision for diminution. So have I touched the investment account? The answer is no. My investment will continue to be at its cost of 700. I have created another account called provision for diminution in the value of investment, which will have a credit balance of 400. And in the balance sheet, when I'm preparing the balance sheet, I will show two rows: cost 700 less provision for diminution 400, final value 300. All right. This provision for diminution will have a credit balance, but it is going to be shown as a reduction from the asset. All right. This will be shown as a reduction from the asset. It is a contra asset account. It will not be shown as a liability despite having a credit balance. All right. So in essence, the entry for current investments and non-current investments is actually the same. I'm debiting loss over here. I'm debiting an expense over here. It's actually one and the same. And over here, I'm crediting investment, but over here, I'm not crediting investment. I create a provision for diminution and I show the net value on the balance sheet. All right. Only the nomenclature is different. At CA intermediate level, please do not fall behind the nomenclature. Try understanding the essence. All right. This is going to be relevant in multiple places. Just because I'm calling something as X and calling something as Y, do not really fall behind that. I may call something as any, I may name any ledger as any way I want to. All right. It's more about just how the convention is or how the practice is. All right. So for non-current, in fact, I shouldn't have written non-current. I should have written long-term investments over here. I'm so sorry. For long-term investments, it's going to be diminution expense debit to provision for diminution. All right. That is the balance sheet date measurement. All right. So we have seen initial recognition. We have seen subsequent recognition on how we actually recognize interest income and dividend income. And we have also seen balance sheet date measurement. All right, current investments we measure at cost or fair value, whichever is lower. Long-term investments we are going to measure it usually at cost. However, if there is any other than temporary decline in the value of investment, then we are going to provide for its diminution, and it will be shown at cost less impairment or the cost less provision for diminution. Both loss on current investments and loss on long-term investments, they will be recognized in the P&L account. Just the only difference is the credit in current investments is being given to the investment asset itself, whereas in case of long-term investment, the credit is being given to a separate account. All right, but eventually on the balance sheet side, we are still going to show it as a reduction from the asset itself. All right, so it's more a presentational difference, not something that you really have to break your heads on. What we are still left with is how do we recognize, how do we de-recognize, which means when I'm selling off an investment, how do you actually account for that, such a account for a de-recognition or account for a sale. However, I would like to continue that in the next lecture. I would stop this with this recording. Uh, Please go through the lecture again if you have any question, especially on the last part of cost of fair value, whichever is lower, and cost less impairment. We will be taking a couple of examples in the next session as well. All right, that's it for this lecture, guys. Thank you so much. Bye bye.